Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, November 9th, 2023. It is 10:29 Eastern Time as I'm starting the video, so we're an hour into the trading day. Wanted to do a quick one, and I'm going to do my best to keep it quick. Just a quick update on the markets and trade ideas. I had a couple questions. I'm going to zoom in here. This is the post I got out to this morning. Remember, there is a unmistakable, unarguable correlation between interest rates and the stock market right now. As I've been saying for weeks and months, the stock market is hypersensitive to rates at this level. We had been for weeks pushing the red line on the tachometer, the upper end of the red line, in my opinion, and or the red line zone. Most tax, again, I'm talking old school. Most, probably half the people listen to my voice don't even have analog or don't even remember analog tachometers on a car. But anyways, that's what that is when you're pushing the revving the engine too hard, and that's what I know was happening to the economy. Whether there'll be some irreparable damage that will pop up later or not, time will tell. But anyways, let's just recognize for what it is. And again, I've done the overlay. You can do it yourself. Overlay the charts, the day, the market, the day interest rates peaked. And then reverse is the day the stock market bottomed in this rally that we've been in for the last week or two, started the last couple weeks. All right. Let me just update these targets here. Well, these, that's what I did. I gave you a chart this morning, and I had some arrows drawn with the pullback. You can see where they were going with the reversal. But what I've done since, and I always encourage you if you're into following a trade, or just come into the site from time to time, check the comments section. A lot of good questions put there, trade updates that may or may not even be relevant to the post above. This one is just a chart. I gave you kind of pullback target zone. You can see here. I zoomed in, it messed up. Let me go back to that. Let's see right here. Pullback target zone on ZB is a minimum pullback target zone. Again, it's roughly where the arrows were drawn, but it's more of a zone, about 112.305 down to 112.114. For those of you that are gaming a pullback in the 30-year, that means ZB if you're a futures trader, which is this chart, or TLT. And then a max target zone right now of the uptrend line. You can see a white uptrend line right here, and then about 110, 200-ish, give or take. It runs from about 110. Really, I should have said about 110, 293. That's the upper line there. That was our former first target. Remember, we were long treasury is right here, right off the lows on that breakout. It was posted first as a setup here. And it's been one of the biggest moves in a long time in treasuries. And again, make absolutely no mistake about it. This is 110% the reason for the stock market rally. It started there, an abatement of yields. The $1 million question, how much more does it have to go? And that's what I'm going to speak to a little bit today. We'll try to figure that out. Somebody asked about Bitcoin. Bitcoin, and this is a chart I posted under there as a reply. We're back testing the wedge. Remember, Bitcoin had this bearish rising wedge right here with divergence right there, broke down recently. And sometimes you break down, never look back. Sometimes you break down and back test. And what I went on to say in that post, it's back testing now. So if it's going to reverse and this trade's going to pan out, now is about the time to do it. If it recovers, if it prints a solid 60-minute close, especially a daily close, that would be a time to maybe consider stopping out if you haven't already on that, because recovery of the trend line means that this whole thing then was a false breakdown, aka whipsaw, bear trap, whatever you want to call it. But as of now, it's simply a back test. This is pretty fresh, this chart. I'm looking at it. We're still right there right now. All right, so those are two trade updates. Also, on another one, somebody asked me about UNG. Was that a previous post? I guess so. Let's see right here. I'm zoomed in quite a bit. TLT. Let me find it. It might have been in that first post from today. And I know probably others have questions. I like crude, by the way. I'm going to get to natural. Well, I jumped in. I had crude already loaded up. Let me just show you that real quick. Crude looks like time to maybe get back in on the long side. As recently as yesterday, I told you I didn't, been staying away from crude and natural gas for the time being. Didn't have much of an interest, but now I'm seeing it come down. This was the old support levels. Third target on this short trade back here. We hit T1, T2, and then reversed. We had a short trade here. We hit T1, T2, and T3. Perfect tag of that T3 and a bounce. I give you 2 bounce targets. T1, 2 both hit. So, we're batting, not 1,000, but damn near 1,000 on crude. And now I like it here. You have, let me show you on the futures. One sec. Oh, and by the way, a minimum target would be this downtrend line right here. Well, that's USO, of course, the crude ETF, or ETN, technically speaking. And this is CL, crude futures, December contract. We're looking at hourly candlesticks here. So 60-minute chart. There's a positive divergence. Nice first little divergent low that I've seen in a while. It could get bigger. We could have another thrust down. If we do, then I'll be revisiting it here in a week or so, or a few days. And that would look like this. Indicators could take another jog down and put in even a bigger divergent low. However, sometimes you don't get that. Right here, look at that. You had same thing. You had this small little divergent low. Let me see. It ends at that point. Take the line down. So you had small divergence, and you got a pretty good rally. Then and if you really count it, that was the low for this whole rally there, and that's well into the double digits. You went from 80 to 90. So that's a double-digit rally. And then even along the way, you had another divergent low right here of equal scope, about the same size there, and that led to that leg up right there. So, all right, that's that. Take it, don't take it. You can put a stop below. You can scale in, however you want to trade it. And there's that same or comparable downtrend line. Actually, even better right here. There's a great target if we do continue to build on this rally, about just over the $80 level. Big was former support. I'm just trying to mark with a box tool here. Keep clicking on it, but it doesn't work. There's resistance there. We broke out. There's your impulsive move after the breakout. Big rally that followed. Back tested it. Big rally that followed. Back test, breakdown. So the way this thing we call technical analysis works, support once broken then becomes resistance. So that's an ideal target. Maybe we zig up and a little react to the trend line, then get there. Alrighty, natural gas as promised. Somebody asked about that. And so my response was, again, it's in the one of the recent comments sections with the chart. I'm not crazy about the fact we broke this. This is the uptrend line off that June divergent low. Pointed that out there. We had a couple trades. We had a trade, nice swing trade. We hit T1, T2. You can consider that a long-term trade if you want, but we've been in a trading range for months now, really most of the year. This is the big trading range right here that we've been in. And we had that divergent low. So, I continue to sing the same song on the update here. We hit T1, T2, and I've said, for months now, unless we take out T2, and I think we will once we take out T2, which was already hit here, and then you had the pullback as expected. You had another run at it. You need to take that out. That's why it's purple. That's an important level to open the door for T3 and T4, and then probably this will be T5 up there. So on one hand, I am certainly not crazy about the fact we broke that trend line. That's off that June divergent low. Every pullback to that trend line's resulted in tradable bounces, and now we took it out. So that's no bueno. We do have a reaction low here, so there's some support. I cannot make a strong case to buy. You could make a case. Traders look at these reaction lows, step in and buy. But again, I have no position, and nor am I crazy about it right now. But it is, again, it's towards the bottom of that range. And so one way to look at it too, when you recognize a trading range, it's a simple MO. You buy the bottom of the range and trade it up to the top of the range, and then go close your long, or turn around or reverse it and go short back down to the bottom of the range. This has been kind of a sloppy-ish range, I call it. It's not super well defined, but that's that. There's your update. What else did I want to cover? Yeah, I know what I wanted to do. I wanted to loop back to Treasuries. So, here's what I wanted to share. Here's the 10-year right here, IEF, the 10-year Treasury. Again, I've been highlighting and put out TLT as a trade idea because my confidence was high enough in Treasuries recently. to get the juice. And it's kind of like I always say, you can trade the S&P 500 or the Dow, or you can trade the Nasdaq 100. You're either going to be right or wrong on your market call for trend and swing trading. You're going to get paid more on the Nasdaq 100, whether you're going long because you're bullish or short because you're bearish. The high growth, high concentration of tech stocks with very high weighting in the top components just makes the Nasdaq go up more than the S&P or Dow in bullish trends, and down more in bearish trends, with very few exceptions. Same thing holds true with treasuries, and this is, again, it's just a known thing. If the shorter the maturity on treasury bonds, you can go with 1 year, 5 years. I mean, there's all kinds of treasury ETFs out there, or futures, but the ETFs, you have SHY, that's the 1 to 3 year treasury bond. Technically called treasury bond. It's not. They call those should be bills. 1 to 3 years treasury bills. And then you have the notes, 5 year. That's IEI. 3 to 7 year, so it's targeting the 5 year bond or note, technically speaking. And then the what one's next? IEF is the 7 to 10 year, or targeting the 10 year. This is the big one the market really watches, but they also do watch the 30 year, and that's TLT. And again, a little more juice in TLT due to longer maturity. So I wanted to loop back to IEF and just say this. So you saw my setup. You saw the pullback, I'm looking for. And also what obviously correlates with a pullback in the 10 year as well. But if that happens, so the pullback that I would have is probably going to take us back down here. And what that would mean, it would be a big time slap in the face for the market for this rally. Because what would happen is IEF would have failed at this downtrend line if I'm right on just my little short-term call for a little pullback of a few percent in the 10 and 30 year. And so what that'll do, again, it'll fail that we had the breakout here, but we'll be below this primary trend line there, and so that'll be a rejection there. Doesn't mean the end of the world, but it could be. Remember the primary trend is bearish, and I've talked about how if we're going to have another big leg down in the bear market anytime soon, if the move off the mid-October 2022 lows was indeed just a bear market rally that ended recently, right now everything just couldn't, the market action feels bullish, right? When you go up this much in short order, it is. And there was, like I said, easily a ton of technical reasons to go long here. However, if it's going to be a bear market, if this is a bear market rally, and this is the highs of the end of the bear market rally, and we're in the new leg down, it would just be textbook to see the rug pull come right now with a lot of people bullish. Look, the odds are against it because the technicals, again, coming off those divergent lows, defended the 200 days, and I haven't maintained my near to longer term, intermediate term bullish stance for treasuries yet, but I'm open to it failing. Like I said, if that 10 year, if it's anything more than just a reaction off the trend line right here in the 10 year, TNX is your 10 year yield. I look at that too, and there's just a super mega bull market uptrend line right there, meaning yields going up. And we're just, like I said the other day, below it, but not comfortably enough below it to say that it's been taken out, plus some price support there. So again, where I'm going is if the pullback, we get back up here, or anywhere here, there's a gap right there, then this is going to be either one of two things. You can call it a successful defense or a reaction, another bounce off the trend line and keeps the uptrend intact for now in yields. The market would shit the bed if that happens. I just tell you right now, if we go back up and get at or punch, especially punch through these previous highs in yields, again, you wouldn't, just strap on and, buckle up your seatbelt with your shorts and hold on, because that, I'm not saying that's going to happen. I'm just laying out a potential scenario to watch. So again, one of two things, it would be considered, at this point, just a successful defense of that, or even you could even say a whipsaw right here, aka bear trap, false breakdown. Again, it hasn't happened yet, guys. I'm just showing you, we technically looking at this, we're right below the trend line. So maybe my little pullback short on treasuries doesn't pan out, meaning yields down, treasuries continue to rally. If yields continue to fall, then that should be bullish for the stock market. So the stock market rally can continue. Okay, so I'm throwing out levels to watch and developments to watch for. So let's take it. Right now I'm taking it day by day, minute by minute. ZB has just put in a new low for the day, but it's not falling hard. And TLT, of course, I'll alternate between the two. Treasury, you're going to have more, I use ZB, not only because it's what I trade personally in my active trading account, but I'll buy this. I have other accounts. I don't, they even just don't have them set up for futures, and I'll just use TLT or any of the ETFs. They're fine. Nothing wrong with them. And so when I look at it here, I've tweaked this trend line. I gave you this chart this morning, but I had the trend line a little tighter before, but I noticed it was violated right here. And so this is what I call BOD, or benefit of the doubt. So I'm tweaking that trend line, and I believe this is probably why Treasuries so far, they're down today. In fact, it's one of the biggest down days in a while, down 1.12% on TLT. But I think they're holding the line right here. Remember, you have you can see here, I'm going to tighten this up a little bit to come right on top of that candle. There's a key reaction high right there, a couple reactions. So this is it. I think we just need a little bit more downside, and the breakdown will become clear. And the odds of this pullback target, I zoomed in here, guys. This was T1 from the trade. Remember, we were long back here, right off the lows. So, and when I zoom in, it moves these little annotations around. That's T1, T2. So as of now, I'm still maintaining these additional higher targets. And as I said in the post the other day, and I reiterated yesterday, it's hard to get too bearish on the market if that happens. But I am not married to this scenario. In fact, I'm not going to say I'd welcome this. I'll just react to it. So if we pull back here, the way it works is, that's a minimum and a likely pullback target, or all the way back down to T1. So call this a target zone if you're, gaming a pullback in TLT. Or sidestepping because you've been long, you want to book profits. This is the biggest move up again in months. TLT, we're up 9% from, roughly from the entry, 8%. If you look at the breakout was right here. So we're up about 8% so far. And remember, it's TLT, it's treasury bonds. So I always suggest typically a 2 times position size. I call it upward beta adjustment because of the inherently low volatility. Treasuries don't go up down 3-4% in a day like the NASDAQ 100 can. So you can usually take twice the position. And so therefore, that's net giving you really a 16 to 18% profit on this trade so far. So, what I mean by that in relative dollar terms, what it put in your pocket. In other words, if you take 10,000 normally in a trade, you take 20 of this. So, 8% is going to give you the same return that a 16% trade in QQQ or SPY would. All right, so that's it. So remember, if we fall down here, it's going to at least bring the 10-year back in line in that trend line. On TLT, let's see if I have a trend line, a comparable one. I'm not crazy about it. I just drew one here. There's a couple reactions there. And so maybe that would be a thing too. And there's also some price resistance. Remember, this T1 was for just a sole target, or these two for more swing and trend traders. But okay, so where am I going with it? Well, based on both technicals and fundamentals, still maintain the fact that we're most likely in the early stages of the next leg down in a bigger bear market. And again, there's not that my convictions will be a lot higher when all the fangs break those purple support levels and the 200-day moving averages that were very successfully tested and defended recently. Okay, so however, if that does prove to be the case, then I'm still going to trade treasuries on their own merits. In fact, here let me go over to one more comment that I made yesterday or last night to someone regarding the jobs market, the jobless claims report. Okay, remember, this wasn't a prediction where we're going to go, just if. These are some of these scenarios I do that, hey, react. this is, I added this there as a little kind of yellow zone, red zone, and saying if they popped up here, then what that would have done, and they didn't, but if they did, it would have kept this near-term uptrend intact, and some would start to realize that, hey, the bottom is in. We see, actually, what happened this morning, there was a knee-jerk reaction. We came in right around or a hair below consensus, I think at 216 or 217, but the continuing claims increased, and that's what the markets also they didn't report it on this. We don't have the continuing claims. I can't remember what they were, but I was turned on the TV and I watched this morning. But here's what I wanted to show you here. All right, so question last night I saw: how is a hot jobless report going to affect our TLT holdings? Well, remember, we didn't get a hot jobless report other than continuing claims. Came in a little hot, and here's my answer. And again, this goes forward. We're going to get jobs data all the time. The ADP report. This was just jobless claims. You have an employment situation. All kinds of. There's various government reports coming out and private reports, like ADP. But what I said here. So again, going forward, something to watch. All other things being equal, a much hotter than expected claims number, or just fill in the blank here as we go forward in the coming weeks, hotter than expected, unemployment numbers. That should be bullish for TLT, as that would indicate two things. Number one, slowing economic growth, which in itself, to expand on that, if there's evidence that the economy is slowing, then by that logic, the market will assume interest rates are going to be down in the future, less demand for money via loans and borrowing, and also a lower chance of any future hikes from the Fed. Obviously, the Fed's not going to do another hike if they see the job market rolling over. Okay, that's about as good as a guarantee as you're going to have. So both of those two should translate into lower yields and higher bond prices. Should claims come in around consensus, which they did, that would probably be a non-event. And a drop well below consensus could trigger a pullback in TLT if the market assumes it may increase the odds of another Fed hike. So there's a lot of moving parts of the bond market and the stock market, but those are some things. And then I added here, to add to those comments, that first scenario I laid out would mesh with the ultimate decoupling of the strong positive correlation between bonds and the stock market that I've been talking about as a possibility. In other words, stocks begin to fall on economic worries, yet bonds continue to rise due to a flight to safety from institutions moving out of stocks and into bonds, as well as, let me just add, the fact that a slowing economy is going to dampen inflation, may even see deflation, and that would bring rates down. So that's what I'm looking at, and that is a prediction that I think we will see coming. Like I said, the jobs report today was just a, hey, look out for, and here's how you react if and when the numbers come out. So far, again, it's been mostly a non-event. But this is a prediction that I do think we'll see at some point in the near future, that decoupling between the strong positive correlation between stocks and bonds. And for those of you not familiar with that, let's just do it this way. Let's go to SPY. Yeah, or we can go QQQ, either one. QQQ is growth heavy. And again, they're not started at the same point. They're not on the same scaling. But as we zoom in here, you can see the candlesticks are TLT, and this is the NASDAQ 100. And you could do the same thing with the S&P. Make no mistake about it. They are lockstep. They both bottomed right here. TLT rallied, meaning interest rates were falling. Stock market loved it, ate it up. Bond stopped rallying there, meaning interest rates had another leg up. The market threw a tissy fit and sold off. Had a little relief rally here, the stock market rallied. Okay, this is a very, very tight positive correlation between bond prices and the stock market. All right, so, and then, again, here's where we bottomed right there. rates kind of stalled out, and I'll even do IEF. Let's see the IEF right there, same thing. So we bottomed out. Actually, it's a little bit of a leading indicator, I should say. I said they bottom on the same day. Maybe if I use candles, I had to look at this. I'm using a line chart, but roughly the same bottom right there. You can see rates bottomed, and then when it became clear to the market, tick, tick, it wasn't even much because the market's hypersensitive. See these higher lows in Treasury bond, the 10-year? And then at that point, stock market said, oh, hey, boy, we got a rally in bonds. And then, boom, stock market took off there. Again, that's the S&P and weight. Okay, so that is a positive correlation. But you go back historically, and it's been that since really this bear market started, because it's all been about interest rates. It's everything right now. And but historically, that's not always the case. In fact, historically, there tends to be an inverse correlation between stocks and bonds, meaning they move opposite to one another. And you've probably heard that many times lately. You know, old 60-40 rule, which worked well for 100 years or more, blew up in 2022. And it was the worst year on record because both stocks and bonds, instead of moving inversely to one another, had a positive correlation. So that 60-40 model tanked out. You lost money on your stocks if you were long, and you lost money on your bonds as well. All right, so that's that. And again, so I laid out the reasons why I do expect that decoupling, because ultimately we will see evidence build that the economy is slowing down and or a recession is either inevitable or underway, at which point that is going to point to two things. Again, lower demand for bonds and fixed income, also lower inflationary expectations due to the slowing economy, buying of less goods and services, and that would bring rates down, which means bonds can rally while stocks are going the other way. Okay, now we're not there yet, and it's not going to be a singular event, more of a developing trend that I'll watch for. As of now, that is not the trend. Therefore, that's why I got that those targets out to you on the treasuries. And here, let me turn off the comparison here and just go to QQQ, which you already have the targets. QQQ, remember we have that resistance about 374, that previous reaction high right there, negative divergence. Here, let me go to my other board. In the target zone I gave you the other day. We're still, I'll give it credit, it's hanging in there, but it's not going anywhere. We haven't gone anywhere for the last few days. It's a 60-minute chart, so the divergence is still very much intact. We're going to need to see bonds pull back, and as long as bonds hold up, if that pullback I'm calling for in the treasuries doesn't happen, at least not now, not yet, then we're probably not going to get this pullback. If so, target one is really the downtrend line, but depending on how it plays out, we may get there, around the same time we hit this. This is T1 here. I had them listed somewhere. There it is. Oh, let me do this. Pull that out here. There you go. Okay, so you can see T1, T2, T3. Same targets I shared with you yesterday. All right, that's that. Okay, and remember the takeaway here is let's watch the pullback in treasuries. If it's an orderly pullback that gets bought up and we just hit those minimum targets, you can see here, then we're probably only going to hit those minimum targets in QQQ. And also in that post I got out to you in the comment section this morning, where I gave that was right here. I noted on here on this chart that I posted in the comments section, for those of you trading and trying to game a pullback in TLT or the stock market, this is what if you expect the buyers to step in here and buy ZB, the 10-year bond, on this pullback target zone, well, that's probably where they're going to step in and buy the Qs as well, QQQ. So therefore, when we get there, if we get there, that's probably going to be about the same time we get to that minimum pullback zone in QQQ, and they start buying treasuries, then they'll start buying QQQ as well. Oh, one more chart, then I'll stop it here. We keep it right at 30 minutes. This is that QQQ low volume indicator I talked about. And, in different market conditions, it works. And then as time goes on, there are different levels. It used to be down here. We'd had to drop to the red or yellow lines. But since this whole bear market thing started back in 2022, this purple line, about covered it the other day, seems to be about 45 million shares. That's where and again, it's a 10-day exponential moving average on the volume that I overlay. And when it hits that level, as you can see, that's typically where the market corrects. And as I also said the other day, it's not a perfect indicator. This time it did the opposite. We got down to that level and the market had a pretty sharp rally, or a continuation of the existing rally. However, what are we looking at again? Since this whole thing started here, zoom back here. So we are, if that's going to be an X, and I said you don't count it right after the signal's triggered, that doesn't matter. So this is our only failed whipsaw. So we are 1, 2, 3, 4, 5 for 5. So I'm sorry, 5 for 6 on it. In other words, here it was just a little bit more upside, but a drop. Even if you shorted the signal there, you still profited on a short. There you had that drop. And here we are. This is my update. I wanted to just say we're right there right now. So what it tells me is not a lot of folks buying this rally. It's been impulsive. And so to me, that kind of reeks of short covering. Again, you can see the volume bars themselves. You can see the 10-day average plummeting, really just nosediving. But you can also see the volume bars, and you can see the volume has just been non-existent. Again, I wish I could say it was 100% reliable sell signal. It's not. It's just one more thing I wanted to add that shows that, hey, right now, I'm a little suspect of the rally, even though I called for it early on. It's pushing the upper, limits of where I thought it would go, which actually exceeded it in QQQ. That did the downtrend line was the max bounce target, but we're also there in other things on that max, the primary downtrend lines. SOX, same thing covered here. That was the target, was a downtrend line, and we're just a hair above it now. And then, as I covered, all the more diversified indexes are also at or just below their primary downtrend lines off the mid-July highs. So I am going to wrap things up here. Keep an eye on Treasuries and QQQ, and I'll most certainly update the Treasuries, see if we get that pullback or not. And then again, if we get that seemingly small pullback, what's it going to do to the more significant daily charts and weekly charts? With that downtrend line on IEF, the 10-year Treasury bond ETF, again, it has implications where we could, just as Treasury bonds are looking ripe for much larger rally, we could have another leg down in bonds, which is another spike up in rates. Again, I'm not making a strong call for that. I'm just going to watch it, and I can tell you that if it starts to materialize, that would be punishing for the stock market. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a good day.